We have some interesting news coming from Waste Management, stock ticker WM today. We can see the company just announced that they have made an agreement to buy Stericycle for $62 a share. Now, Waste Management is actually a company I own in my personal dividend portfolio, and it's one of the few additions I've made to my portfolio over the past year. If we go ahead and zoom in and look at my growth chart, you can see right here, it looks like on my Waste Management position, I'm currently up around 29.28%. Now, just a few days ago, I was actually up quite a bit more because we can see Waste Management is currently down around 5% on the day. So in this video, we're going to be talking about why I personally own Waste Management in my portfolio, talking about the recent news, looking at the investor's presentation, and then of course, we're going to be jumping into a valuation of Waste Management. And like always, if you'd like to download any of my spreadsheets, then you can head over to tickerdata.com at the link in the description. So let's go ahead and jump into it. Now, like I've already mentioned, on the day, Waste Management down close to around 5%, but we can see over the past year, they've done pretty well. They're up around 24% and year to date up around 12%. Now, personally, the end goal for my portfolio is to one day be able to live off dividend payments. So I want to make sure I'm buying stocks that can sustainably grow their dividend payments over time. So let's go ahead and look at them from a dividend perspective. If we jump over to my dividend breakdown sheet, again, available on tickerdata.com, if we come up here and plug in WM and hit enter, we can see all this data is going to automatically load in. Now we can see the starting dividend yield for this company as of right now sitting right at around 1.5%. So it's a little bit on the lower yielding side. But if we come down here, we can see the company does have a good history of increasing those dividend payments over the past decade, going from about $1.46 to $2.80. And with their most recent dividend hike, they are sitting at $3 per share. So we can see they have a 10-year dividend CAGR pretty decent at about 7.18%, in the 5-year sitting at 7.91%. So basically 8% dividend growth. That's pretty decent dividend growth. Now let's touch on the safety of these dividend payments. We can see payout ratio sitting at 49.31% and the free cash flow payout ratio sitting at 62.28%. And if we come over here and look at the free cash flow payout ratio over time, we can see for the most part over the past decade, it's been sitting in the range of around 40 to 60%, but it's a little bit higher as of 2023. Again, this is the highest it's been in the past decade at about 62.28%. Now, I don't necessarily think that's a bad thing, but it is a little bit higher than it has been historically, which is something to keep in mind. And if we come down and look at the free cash flow versus dividends paid out, we can see why this is. Now, obviously, the red bar charts are showing us the amount paid out in dividends, and this is increasing every single year. And for the most part, free cash flow has done a pretty good job growing over the past decade, but we can see it slipped a little bit over the past couple of years. In 2021, free cash flow was around $2.4 billion, but in 2023, it's jumped down to around $1.8 billion. So this decline in free cash flow while dividend payments are increasing has led to the higher free cash flow payout ratio over time. Now, again, we have to put this into context. What is the goal for management? How much of their free cash flow do they want to be using to pay out dividends? Well, we can actually get some insights by jumping over to the investor's presentation. And the one that I'm pulling up is a little over a year old. But one of the things we'll notice is if we come down here, we can see the company is targeting a 40 to 50% payout of free cash flow. So with that in mind, we now know that free cash flow payout ratio is currently a little bit higher than they typically like to see it. So we can see from around 2016 all the way to 2021, that free cash flow payout ratio was in a very healthy range, right where they're targeting, but it's gone a little bit higher than they'd like to see over the past couple of years. So we do have to keep that in mind. Now, when we talk about capital allocation, we have to remember there's 5 different things a company can do with their free cash flow. And like we've already seen, they're currently targeting around half of their free cash flow being used to pay out dividends. So we have to keep that in mind as an investor. It tells us how they're going to reward us. We have to keep in mind they can also reinvest that capital, they can buy back shares, pursue mergers and acquisitions, and also pay down debt. And we actually can see a pretty good history over the past 3 years, 2019 through 2021, of how they're using their capital. Again, this gives us an idea of how they're going to reward their shareholders. So something else they've been doing other than paying out dividends is actually buying back shares as well. If we jump over to my stock screener sheet, if we come up here and plug in WM and hit enter, again, all this data will load in. Now, what I want to point out is if we come down here and look at shares outstanding, like I just mentioned, they bought back a decent amount of shares over the past decade, especially a little bit more, I think, in the past 2 or 3 years. We can see in 2013, shares outstanding was around 467 million, but in 2023, all the way down to around 404 million. So a decent job buying back shares during this time period. They've used a decent amount of free cash flow to do this, just like we just saw. Now, if we jump back over to the investor's presentation, we can also see, yes, obviously, we want every company we buy to be reinvesting back into the business. This is one of the best ways for them to organically grow. But also, we can see they are pursuing mergers and acquisitions. And this is one of our main subjects for the day. Like I mentioned earlier in the video, Waste Management confirmed a deal to buy Stericycle for $62 a share. So why is Waste Management down around 5% on this news? Well, we have to understand, if we jump over to Stericycle, look at this. We can see over the past year, they're up around 40%. But if you look at where they were before the news was announced, they were trading at around $45 per share. And again, if we jump back over to this news, we can see Waste Management is paying around $62 a share for this company. And if we scroll down, we'll get some more context. We can see the price represents a 24% premium to Stericycle's 60-day volume weighted average price as of May 23rd. So it looks like Waste Management is paying a little bit of a premium to acquire Stericycle. Now, what even is Stericycle? What kind of company is it? Well, we can see they're a regulated medical and compliance services company. Now, the big argument that Waste Management is making is this will expand Waste Management's comprehensive environmental solutions in the growing healthcare market while advancing Waste Management's sustainability commitments. And they basically state that the healthcare market is a sector with attractive near and long-term growth dynamics. Now, if we jump back over to our stock screen and plug in Stericycle sticker and hit enter, and honestly, what we see isn't anything too impressive. We have negative earnings per share in 2023. Return on invested capital has been pretty bad for about a decade now. We can actually see shares outstanding has increased a little bit over the past few years. Now, Waste Management also argues that this acquisition will boost their earnings and cash flow within 1 year of closing. So we'll have to wait and see if that's actually the case. So in reality, only time will tell if this is actually a good acquisition, but it is pretty clear they are paying a premium for this company. Now, if we dig a little bit deeper into the investor's presentation, I actually want to point out some of the key factors that made me feel good about buying this company about a year ago. The 2 key points I want to point out on this page on the investor's presentation is we have recession-resilient revenues and lowering cost to serve and differentiating customer experience through technology and automation. This is something we're going to touch on as we go through this. If we go ahead and jump to the 7th slide again, recession resilient, we can see provide customers and communities with an essential services. Waste Management is obviously not going anywhere anytime soon. And as a result of this, we can see 75% of revenue has annuity-like characteristics. As an investor, I absolutely love that. Something I'm willing to pay a premium for, along with a lot of other investors, is predictability and stability. So when I buy a company that has 75% of the revenue with annuity-like characteristics, it gives me a lot of confidence in the future growth of the company. I know there's a lot of stability and predictability with the revenue that they're bringing in. And if we jump over to my profitability spreadsheet, we can see a pretty good example of this. Even though free cash flow wasn't quite as high in 2023 as it was in 2021, we can see revenue over the past decade has actually done a pretty good job of growing. Now, some of this is through mergers and acquisitions, but again, revenue is predictable, it's stable, and it's growing. And then like I mentioned a moment ago, they're looking to lower the cost to serve and differentiating customer experience through technology and automation. And this is not something I see discussed pretty often when people look at Waste Management stock, but it is something they are actively pursuing. And in fact, I actually wrote about this in an article on Seeking Alpha a few months ago. Here's a few key ways they are looking to reduce costs. We can see they're pursuing autonomous trucks, smart containers, and using data-driven insights. All these are ways that the company can potentially lower cost moving forward in the future. And the end result of lowering costs is going to be better gross profit margins for Waste Management. And in fact, if we jump over to my profitability spreadsheet, we can see gross profit ratio has actually been slightly increasing for Waste Management over the past decade, but I think they have even more room for improvement. We can see the 10-year average gross profit ratio sitting at about 37.4, but in 2023 sitting at about 38.28%. So again, this is something Waste Management is looking to improve as it'll add more dollar signs to the bottom line. So when we look at the growth drivers for Waste Management looking forward, yes, they're looking to lower costs like we just mentioned with technology. They're looking for sustainability-led growth, basically reinvesting back into the business, but like we've already seen, they're also pursuing strategic mergers and acquisitions. I think a huge factor of their success moving forward will be how these strategic mergers and acquisitions perform. They've had success with this in the past, and we'll have to see if that's the case in the future. Now, like I mentioned earlier, the growth for Waste Management is very predictable. It's very stable. It's not necessarily a high growth rate, but as someone who's investing for the long term, I love predictability. And so when we look at the projected growth of the US waste management market moving forward over the next decade, we can see the CAGR is projected to be about 5.2%. Again, not necessarily high, but it is predictable. I can feel pretty confident in this number. But here's something else that I really like. If we keep scrolling down and look at this chart, there's a few market characteristics about waste management that I really like. Let's start at the bottom here. If we look at product substitutes, there's very few product substitutes for waste management. It's hard to enter the market and there's not a lot of competition. And there's not really any substitutes for waste management as well. There's not very many. But then, like I mentioned a moment ago, the degree of innovation is actually relatively high. I know when we think of innovation, we think of tech companies, but waste management could really benefit from this moving forward. So with all that being said, with waste management down around 4.66% on the day, trading at $200, is it a good price to consider buying? Let's go ahead and jump into my stock valuation spreadsheet to find this out. We'll come up here, plug in stock ticker WM and hit enter. And we can see all this data is going to automatically load in. Now, if you're curious how this is loading in, this is thanks to the Ticker Data add-on in Google Sheets. Again, you can download any of my spreadsheets on tickerdata.com, and you can also get the Ticker Data add-on that allows you to automatically import stock financials straight into your spreadsheet. Let's go ahead and look at our 3 different valuations. Now, the first one I want to look at is our discounted cash flow analysis. Again, this is valuing a company based on how much free cash flow the company is going to produce in the future. And you can see with all of these different assumptions, we actually come to a pretty low valuation of around $117.73 per share. So according to the DCF model, looks like the company might be a little bit overvalued. If we jump over to our multiples valuation, this tells a little bit of a different story. We can see these comparable companies like RSG, WCN, CLH. They trade at pretty high multiples. Price to earnings multiple for these companies is high. The average PE is sitting at 39.53 for these companies. That is really high. If we apply that same PE ratio to Waste Management, we come to an intrinsic value of around $224.93. And then finally, if we jump over to our dividend discount model, this values a company based on how much they pay out in dividends and how much that dividend is increasing over time. So we can see the yearly dividends right here and the dividend growth rates. Over the past few years, they have an average growth rate of about 8.35%. So moving forward, I'm projecting a dividend growth rate of 6.5%, discount rate of 8%, and that gives us a dividend discount model price per share of $213. So when we jump over to the output tab, we can see the three different valuations that we used. We have DCF at 117, DDM at 213, and multiples at 224. And when we average those three together, we come to an intrinsic value of $185.22 per share, a little bit lower than that current trading price. So with a 10% margin of safety, acceptable buy price is around $166, and with a 20% margin of safety, acceptable buy price of around $148 per share. So again, it might be slightly overvalued at its current prices. And to kind of reaffirm this, if we look at how the company has been valued historically, if we jump over to Seeking Alpha and go to valuation, look at this. We can see the 5-year average price to earnings non-GAAP for Waste Management sitting at about 29.38. If we look at where they are now, it's about 31.78. So even compared to where they have been historically, it looks like the company might be trading a little bit at a premium. Now, with that being said, I'm perfectly fine holding my Waste Management shares right now and reinvesting dividends. I still believe in the company long term and think they have very predictable and stable growth, and the dividend growth will follow as a result of that. So go ahead and let me know what you think of Waste Management in the comments down below and what you think of the new acquisition that they are actively pursuing. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the Ticker Data add-on in Google Sheets, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.